When stocks go down, we can still make a profit with a call credit spread, and I'll show you exactly how to set that up in the Robinhood app. So right now we're looking at Invesco QQQ. It's an ETF that tracks the top 100 NASDAQ stocks, which are mostly tech heavy. And although I have a long-term belief that QQQ will just go up to the moon, and keep increasing, and I personally think that's a good ETF to invest in long-term. Recently, you can see on the week view, it did have a drop starting November 13th. And so it did have some recovery. Looks like some people bought it back at high volume and it made the stock shoot back up, but not all the way. So we might as well profit off of other people's fear that the QQQ is still a little shaky, where it could possibly go down. So we're going to have a bearish outlook on this short term and make some profit from it from a bear credit spread. And let's see. So just to get a little overview, first what I do when looking at these is I look at the highs for the past week or, recently. And if you hold down your finger on the chart, move it around, and look at the high value, we see we almost touched 625, but not quite. Now we went above 625, went around 626, a little above that, then it dipped back down. So it looks like 626 is pretty much our ceiling that the QQQ has been hitting recently. So maybe it won't go above that. So remember that number, 626. Now to place the call credit spread, you can click on trade options. And I like this option strategy builder. You could say, I think it's going to go up. I think it's going to go down. It's going to trade sideways, or it'll stay the same. I'm sorry, the price will go up or down outside of a neutral zone. You think it's going to be volatile in the future. And then this one is where it stays the same. So we think it's going to go down. This is a simpler strategy than those other two to the right. And something called vertical spread. We want the call credit spread. Credit means we get money to open up the deal. Debit means we spend money to open up the deal. So obviously we want some money for this, right? So we'll click on call credit spread. And you can pick the expiration date. I'm just going to go with whatever soonest. So November 17th, 3 days from now. And you'll notice if you fiddle around with the width or strike prices, you'll see what looks good. So if our width between strike prices is $1, let's just take a peek at what that would be with let's just practice on the 615. Max profit, $36, max loss, $64. So that's a width of $1 on the 615 lower strike price. What if we increase the width by a lot? What happens? Let's go to the 615, and you can see max profit a measly $200 something compared to max loss of about 10 grand. So obviously, the wider the width between strike prices, the more likely you will lose a lot of money. So these kind of things don't make sense. So that's why we're going to set the width to the smallest amount, $1, because that'll give us the best risk to reward ratio. You can see the share price jumping around between these strike prices. So what did we say for what this will stay below? 626? Surely it can't go above that. So if we click on that, we can see our max profit's only $4, max loss is $96. That's terrible. We're going to have to give up that certainty of the stock not rising above that. We'll have to go down a little bit to something more realistic. Maybe 620. Maybe we think it won't rise above that. So we click on that. This is looking better. Max loss is about 4 times our max profit. We want to have a ratio of profit to loss as 1 to 3 as a rule of thumb. So we'll have to go down a little bit. This one's better. So whenever this ratio looks better, it makes more sense for the deal. But on the other hand, it becomes more likely that the underlying price will shoot up above our lowest leg and possibly shoot up above our highest leg, and then we reach our max loss. But this is about double. That's really good, but it has a higher chance of becoming true, so maybe we can bump it up a little. No, that's 1 to 4. What do we want here? Maybe 618. Okay, so this is the sweet spot. Max profit compared to max loss, roughly 1 to 3. Basically, if you took the ratio of about $25 compared to $75, you simplify it, it becomes 1 to 3. We're risking $3 to make $1. And if we look at our chart right now, the price is $611. If it sank all the way to 0, we would still make money. We would still have total profit, max profit of like 20 something bucks. But if it rises up 1%, then we start getting into losing territory and have a max loss of about $75, $76. So that's how we would set up this call credit spread. We're betting that the price will either stay the same or go down. We have some room where we think within 3 days it'll stay under $618. So that's kind of what we're betting on happening. So if you like that risk to reward ratio and you think, oh yeah, it's not gonna shoot up past 618 in 3 days, then you can click continue. And we'll put in an order for one of these. And if you go in the top right, it says limit order. Time enforced, you can either have it for good for day or good till canceled. So I'm just gonna leave it good for day. That's mostly what I do for options anyway, just because these things can change from day to day. So we'll just leave it as is. And let's see, let's do 0.23 medium fill likelihood. What happens if you do 0.25 low fill likelihood? Okay, so this is saying I want to receive $23. I want to receive $22 medium fill likelihood. So we'll get $22 for entering into this deal. And if you're happy with that, you can click review, and then we can look at everything. So entering into this deal, we get $22, risking 100, and we can swipe up. Pending filled. Perfect. All right, and that is how you enter into a call credit spread. We've received money, and we're saying we bet that this stock is going to stay below a certain strike price, which in our case is $618. It expires in 3 days. Hopefully that's a short enough time frame where it's not gonna shoot up past that. We'll profit off of the market's short-term fear right now, and hopefully be able to make a profit. We always have a few days to close it and cut our losses, or maybe roll it out or manage it in some way. But for now, if everything goes according to plan and it stays below our lowest strike price, we get to keep the $22 and re-employ this strategy later. So if you like this kind of content, go ahead and give it a like and subscribe, and I will see you next time.